Yesterday, something happened that most people completely missed. February 14th, 2026. While everyone was distracted by Bitcoin bouncing around $65,000 after its brutal crash from $126,000 just months ago, Elon Musk's team quietly confirmed something that could fundamentally reshape how hundreds of millions of people interact with money. And here's the thing that should terrify traditional finance. They're doing it at the exact moment when everyone thinks crypto is dead. Before we get into what's actually happening here, I need you to do something that helps this channel bring you more content like this. Hit that subscribe button. We're the Wealth Continuum, and if you're watching from anywhere in the world, drop your location in the comments. I want to know where our community is learning about these shifts in the financial system. Because what we're about to discuss isn't just another tech feature. This is about the infrastructure of money itself, changing in real time. So here's what happened yesterday. Nikita Beer, the head of product at X, the platform formerly known as Twitter, publicly confirmed that within the next few weeks, they're rolling out something called smart cash tags. Now, if you're not paying attention, that sounds like just another feature update. But let me explain what this actually means, because the implications are staggering. You'll be able to tap any ticker symbol in your feed. And let's say $BTC for Bitcoin or $TSLA for Tesla. And instead of just seeing search results, you'll get real-time price charts, market data, trending discussions. And here's the critical part. The ability to execute trades immediately without ever leaving the app. No switching to Coinbase. No opening Robinhood. You see a post about Bitcoin volatility, you tap the cash tag, you see the price, and you can buy or sell right there in seconds. Think about that for a moment. X has over 600 million monthly active users. 600 million. That's not a niche platform. That's not some crypto exchange serving degenerate traders. This is where presidents announce policy, where markets move on single tweets, where billions of dollars of decisions get made based on what people read in their timeline. And now that same platform is becoming a trading desk. But here's where this gets really interesting, and why the timing of this is either brilliant or completely insane, depending on how you look at it. Bitcoin just had one of its most violent crashes in history. We peaked at around $126,000 back in October 2025. That was the top, the euphoria moment. Then came the breakdown. By early February just last week, Bitcoin briefly fell below $60,000. We're talking about a 50% drawdown from the highs. The crypto fear and greed index hit extreme fear levels we haven't seen since the FTX collapse. $8.7 billion in Bitcoin losses were realized in a single week. Retail traders, the people who drove the last bull runs, they're gone. Studies show retail participation in crypto markets has collapsed to around 5 to 6%. Institutional money now accounts for 95% of inflows. The average person, the one who bought at $80,000 thinking they'd get rich, they're either holding bags or they've capitulated entirely. So Elon Musk and his team at X are launching a feature designed to make trading frictionless, to eliminate the barriers between social media and financial markets, right as retail investors are fleeing crypto in terror. That's the setup. And if you think that's a coincidence, you haven't been paying attention to how Musk operates. Let's talk about what this really is. This isn't just a convenient feature. This is a fundamental architecture change in how information flows into action. Right now, there's friction in the system. You read something on X about a market move, you get interested, you have to open another app, log in, navigate to the right asset, place an order. Every one of those steps is a moment where you might change your mind, where momentum dies, where doubt creeps in. X is removing all of that. They're compressing the cycle from information to action down to seconds. You see it, you tap it, you own it. That compression is everything. And this fits into Musk's much larger vision that most people still don't fully grasp. He's not trying to make X a better social media platform. He's trying to build what he calls an everything app, modeled after WeChat in China. In China, you use WeChat for messaging, but also for payments, for ordering food, for booking travel, for investing, for basically every financial transaction in your life. Musk has been very explicit about this. When he bought Twitter for $44 billion back in 2022, he said buying Twitter was an accelerant to creating X, the everything app. Most people thought that was just hype, but look at what's actually been built. X now has money transmitter licenses in over 40 US states. They've partnered with Visa to process payments. They're testing a digital wallet called X Money with internal employees. Musk said publicly that external testing of X Money could begin within 1 to 2 months, with a full launch later in 2026. He described it as the planned central source of all monetary transactions for users. So the trading feature isn't standalone. It's one piece of a broader financial infrastructure being built in plain sight. And once that infrastructure is live, once hundreds of millions of people have X Money wallets and are used to executing trades in their feed, what happens next? Do they stop at stocks and Bitcoin? Or do you suddenly have the ability to pay your rent, send money to friends, buy products, invest in markets, all without ever leaving the same app where you argue about politics and watch videos? That's the vision. And if it works, it doesn't just compete with Coinbase and Robinhood, it competes with your bank. Now, let's talk about Bitcoin specifically, because this is where things get really interesting. Bitcoin is designed to be decentralized, permissionless money. The whole point is that you don't need a bank or a middleman. But adoption has always hit the same wall, which is complexity. Most people don't want to manage private keys. They don't want to worry about sending Bitcoin to the wrong address and losing it forever. They want convenience. They want the thing that works like their bank account, even if that defeats the philosophical purpose of Bitcoin. And that's exactly what centralized platforms like Coinbase provided. They made crypto easy. You sign up, you buy, you hold, you sell. It works like any other app, but it's still a separate thing. You still have to consciously decide to go to that app, to engage with that world. X changes that dynamic entirely. If trading is embedded in the place where you already spend hours every day, where you already consume financial information, where market narratives are created and spread, then the friction disappears. You're not making a separate decision to go trade crypto. You're just responding in real time to the information in front of you. And that changes behavior at scale. Here's the thing people miss about markets. They're not rational. They're emotional, social, driven by narratives and momentum. And where do narratives spread faster than anywhere else? Social media. Specifically X. Crypto Twitter has been the engine of every Bitcoin bull run. It's where memes turn into movements, where influencers pump coins, where FOMO spreads like wildfire. But until now, there was always that gap between the narrative and the action. You rid the hype, then you had to leave, go somewhere else, execute the trade. X is closing that gap. The narrative and the transaction become one continuous flow. Now, here's where I want you to think critically, because this cuts both ways. On one hand, you could argue this democratizes access. Suddenly, people who would never have opened a Coinbase account, who found the whole process intimidating, they can participate. They see Bitcoin trending, they tap, they buy $10 worth just to be part of it. That brings liquidity, that brings new participants. That could theoretically drive adoption. But on the other hand, you're also removing every speed bump that might protect people from their worst impulses. You're making it easier to FOMO into the top of a pump, to panic sell at the bottom, to trade emotionally instead of strategically. And in a market as volatile as Bitcoin, that's dangerous. When the next viral tweet hits about Bitcoin going to 500,000 and millions of people can buy instantly with one tap, what happens to the price? It spikes hard. And then when the narrative flips, when fear takes over, those same people sell just as fast. The volatility doesn't decrease, it amplifies, and Musk knows this. He's not naive. He understands how sentiment works, how crowds behave. Remember, this is the guy whose tweets have moved markets for years. When he changed his Twitter bio to include Bitcoin, the price jumped. When he said Tesla would accept Bitcoin, then reversed course, the market crashed. He's acutely aware of his influence, and now he's building the infrastructure to channel that influence directly into transactions. That's either genius or reckless, and honestly, it's probably both. Let's talk about the regulatory side, because this is where things could get complicated. Financial markets are heavily regulated, especially in the United States. You can't just let people trade stocks and crypto without proper oversight. There are know your customer laws, anti-money laundering requirements, investor protection rules. So how does X plan to navigate this? Right now, we don't have complete answers, but we know they're working with partners. They have those state-level money transmitter licenses, they've partnered with Visa, they're clearly building compliance infrastructure. But the big question is whether they'll operate as a broker-dealer themselves or partner with existing licensed entities. And depending on which path they choose, the regulatory burden changes dramatically. If they're just a front-end interface connecting to regulated partners in the background, that's one thing. But if they're trying to become the broker, the custodian, the exchange, all in one, then they're stepping into a regulatory minefield that has destroyed companies before. And here's where the timing matters again. The US government under Trump has been relatively friendly to crypto. They established a strategic Bitcoin reserve. They appointed David Sachs as the first crypto czar. There's been talk of clearer regulatory frameworks. The SEC approved spot Bitcoin ETFs back in early 2025, which opened the door for institutional money. So the regulatory environment is more favorable than it's been in years. But favorable doesn't mean absent. And if X makes a mistake, if there's a security breach, if user funds get lost or stolen, if there's any whiff of market manipulation, the regulators will come down hard. Because this isn't some niche exchange. This is a platform with hundreds of millions of users, many of whom have no idea what they're doing when it comes to trading. The reputational and political risk is enormous. Now, let's zoom out and talk about what this means for Bitcoin's long-term trajectory. Bitcoin has always had this tension between being a revolutionary technology and being an actual usable currency. The believers say it's digital gold, a store of value, a hedge against inflation and fiat currency debasement. The skeptics say it's too volatile, too slow, too speculative to ever be real money. And both sides have valid points. Bitcoin has created generational wealth for early adopters. There are now over 192,000 Bitcoin millionaires. The top holders, people like Satoshi Nakamoto, who owns over 968,000 BTC, the Winklevoss twins with 70,000, Michael Saylor's personal holdings of 17,000. These are massive concentrations of wealth. But at the same time, Bitcoin still doesn't function as a medium of exchange at scale. You can't pay your mortgage in Bitcoin. Most merchants don't accept it. It's primarily treated as a speculative asset, something you buy hoping the price goes up. What X potentially does is push Bitcoin further into the speculative asset category while simultaneously increasing its cultural visibility and legitimacy. If millions of people are trading Bitcoin in their X feed, if it becomes as normal as checking stock prices, then it's culturally normalized. It's not some weird internet money anymore, it's just another asset you can trade. But that doesn't make it a currency, it makes it a casino chip. And maybe that's fine. Maybe Bitcoin's destiny is to be digital gold, something you hold because you believe in its scarcity and decentralization, not because you're buying coffee with it. But the original vision, the Satoshi white paper vision of peer-to-peer electronic cash, that gets further away with every step toward centralized trading platforms. Here's something else to consider. X currently has 600 million monthly users, and Musk has stated the goal is to reach 1 billion. If even a fraction of those users start trading crypto through X, we're talking about an influx of new participants that dwarfs anything we've seen before. Coinbase, the largest US crypto exchange, has around 110 million users globally. Robinhood has about 24 million funded accounts. X could bring in multiples of that. And those new users won't be crypto natives. They won't understand decentralization or self-custody or the difference between Bitcoin and Ethereum. They'll just be people who saw a viral tweet and decided to buy $20 worth of something. That changes the composition of who holds Bitcoin and why. It tilts even more toward retail speculation and away from ideological conviction. But let's play devil's advocate for a moment. What if this actually works to stabilize Bitcoin long term? Right now, Bitcoin ownership is concentrated. Whales and institutions hold massive amounts. When they move, the market moves. But if you distribute Bitcoin across tens of millions of small holders through a platform like X, you're broadening the base. Yes, those holders might be less sophisticated, more likely to panic sell, but they also represent sticky distributed ownership. And if X integrates Bitcoin into other services, if you can use your Bitcoin holdings as collateral for loans, or to pay for premium features, or to send cross-border payments, then it starts to have utility beyond just speculation. That's the optimistic case. The pessimistic case is that this becomes the peak of the next bubble. Remember, we're in a bear market right now. Bitcoin is down 50% from its highs. Retail has fled. Sentiment is terrible, but markets are cyclical. At some point, the next bull run begins. And if that bull run coincides with X's trading feature being fully live and marketed aggressively to its user base, you could see a speculative frenzy that makes previous cycles look tame. Imagine viral tweets about Bitcoin hitting 200,000 and millions of people one-tap buying in a matter of hours. The price would go parabolic, and then, inevitably, it would crash. Because that's what speculative bubbles do. They inflate and they pop. And when the pop happens, when millions of unsophisticated investors lose money, there will be consequences. Political consequences, regulatory consequences, reputational consequences for X and for Bitcoin. Now, let me connect this to the broader macro picture, because Bitcoin doesn't exist in a vacuum. We're in a strange economic moment. The Federal Reserve has paused rate hikes. Chair Jerome Powell described current rates as sitting within a neutral range, which signals they might stay here for a while. Inflation has cooled from its peak, but it's still above target. The US dollar remains strong, which historically has been bad for Bitcoin because Bitcoin is often seen as a dollar alternative. But there's also massive government debt, geopolitical instability, concerns about the long-term viability of fiat currency systems. Those concerns drive people to Bitcoin. So you have conflicting forces. A strong dollar and stable rates pulling people toward traditional assets, but structural fears about debt and debasement pushing people toward decentralized alternatives. X's trading feature doesn't resolve that tension, but it makes it easier for people to act on whichever impulse they're feeling in the moment. Here's a question I want you to think about, and I want you to answer this in the comments because this is important. Do you think making trading easier, making it more accessible, more instant, more social, is actually good for people? Or does it just make it easier for them to lose money? Because there's a real argument that friction is protective. The fact that you had to consciously decide to open a separate app, to fund an account, to go through verification, that friction gave you time to think, time to research, time to not act purely on emotion. X removes that time. You tap and you're in. And in a volatile market like Bitcoin, that could be devastating for a lot of people. So is this democratization, or is it just creating more efficient ways to separate people from their money? I genuinely want to know what you think. Let me also talk about what this means for competition in the crypto space. Coinbase, Binance, Kraken, these platforms built entire businesses around being the gateway to crypto. They invested heavily in security and compliance and user experience. And now X comes in and potentially bypasses all of that by leveraging its existing user base and social graph. If you're Coinbase, how do you compete? You can't match X's distribution. You don't have 600 million users. You don't have the cultural relevance. Your only advantages are trust, security, and being a dedicated platform. But are those advantages enough when the alternative is instant, seamless, integrated into the app people already use every day? This is an existential question for those companies, and I don't think they have a good answer yet. And then there's the question of what happens when other platforms follow. Because if X does this successfully, do you think Meta won't try? Do you think TikTok won't explore it? Suddenly, every social media platform becomes a potential financial platform. And that changes everything about how finance works. We go from siloed systems, where you have your bank, your brokerage, your payment apps all separate, to integrated ecosystems where everything is bundled. And that bundling creates enormous power. Because once you control the social layer, the information layer, and the transaction layer, you control the entire loop. You shape what people see, what they believe, and how they act on it. That's not just financial power. That's structural power over behavior itself. There's also a national security dimension here that people aren't talking about enough. If X becomes a major financial platform, handling billions or trillions of dollars in transactions, that makes it critical infrastructure. And critical infrastructure is a target for hackers, for nation states, for anyone who wants to disrupt the system. We've already seen exchanges get hacked. We've seen billions stolen. X would be an even bigger target because it's not just money, it's data, it's communications, it's influence. The security standards would have to be absolutely airtight. And historically, that's hard to achieve at scale. One breach, one failure, and the entire thing could unravel. So there's real risk here, beyond just market risk. Let me bring this back to the original question. Could X's trading feature change Bitcoin forever? The answer is yes, but not in the way most people think. It won't change what Bitcoin is fundamentally. Bitcoin is still a decentralized, permissionless protocol. It still has a fixed supply. It still operates according to its code. What changes is how people interact with it, how they access it, how they think about it. And those changes matter enormously because Bitcoin's value isn't just in its technology. It's in its network, in adoption, and how many people use it and believe in it. If X brings tens of millions of new people into contact with Bitcoin, that expands the network. It increases legitimacy. But it also increases speculation, volatility, regulatory scrutiny. So we're at this weird inflection point. Bitcoin is down massively from its highs. Retail has abandoned the market. Institutional money is cautious. And right at this moment of maximum fear, X is building the infrastructure to make trading more accessible than ever before. If the timing is right, if the next bull run starts just as this feature goes live, we could see a speculative wave unlike anything before. But if the bear market continues, if Bitcoin keeps grinding lower, then this feature launches into silence. People won't care. They'll be too hurt, too skeptical, too burned from the last cycle. And maybe that's the real genius of the timing. Launch during the bear market when expectations are low. Build the infrastructure while no one's paying attention. Then when sentiment shifts, when the cycle turns, you're already there. You're embedded. You're ready. And the flood of new users doesn't have to overcome barriers because the barriers are already gone. I want to leave you with this. We're watching the financial system evolve in real time. The lines between social media, information, and transactions are blurring. The institutions that controlled finance for decades are being challenged by platforms that control attention. And Bitcoin, this weird experiment in decentralized money, is caught in the middle. It's being pulled in different directions, toward institutional legitimacy with ETFs and corporate treasuries, toward retail speculation with integrated trading features, toward being digital gold or being internet casino chips or being something else entirely. What X is building matters because it's infrastructure, and infrastructure shapes behavior. It shapes markets. It shapes what's possible and what's normal. Whether this ends up empowering people or exploiting them depends on execution, on regulation, on how people actually use it. But the change is coming. It's already here. February 14th, 2026, that's the date. That's when the pieces started moving into place. And everything that happens next flows from this moment. So here's what I need you to do. If this analysis made you think differently about what's happening, if you understand now why this matters beyond just another app feature, subscribe to the Wealth Continuum. Drop a comment with your biggest concern or your biggest opportunity you see in this shift. Tell me where you're watching from, and think seriously about what this means for how you interact with money, because that interaction is about to change whether you're ready or not. The system is being rebuilt. The only question is whether you understand what's being built and why.